Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, March 14th, 2022, and I am pre-recording this Trading Places Live for Tuesday, March 15th. Currently, futures, well, still got a long ways to go between now and the Tuesday open. But currently, Dow and S&P 500 futures are relatively flat. NASDAQ futures up about 37. So NASDAQ, which had underperformed during the day on Monday, looked like they're, at least futures look like maybe we'll have a little bit better day, or at least maybe a little better start tomorrow morning. But of course, a lot of things can change overnight. So we'll see how things open up on Tuesday. Crude oil futures, though, are down, or crude oil itself is down to $99 a barrel. So that's pretty good news considering where we were just not that long ago, less than 2 weeks ago. I think we were, what, $130 a barrel. So definitely have pulled back quite a bit there. 10-year Treasury yield up to 2.16%. That is a problem. And of course, we have the Fed meeting the next 2 days, Tuesday, Wednesday, with that Wednesday announcement at 2 p.m. So lots going on there. Let me go ahead and run you through today's agenda. We'll start off, as we always do, with daily market recap. Then we'll jump into talking technically. Going to take a look at sentiment, give you an update there. Earnings spotlight, and then we'll wrap up with the 3 you must see. Before we get into any of that, though, let me take you over to earningsbeats.com. For those of you that are new to us, welcome. We certainly love to have folks join us. And I think we have some pretty good information to share from time to time. I think can help to improve your trading results or investing acumen, if you will. I learned from one of the best, John Murphy, and I love paying it forward. And so that's why I do these shows, write my blogs, and really why we have earnings beats. It's to try to pass a lot of knowledge on to other folks who are interested. All right. If you go to earningsbeats.com and you want to get some more information from us, we do have a free newsletter. It's our Earnings Beats Digest newsletter. That will provide you some pretty good information 3 times a week, Mondays, Wednesdays, and Fridays. All you need to do is type in your name, email address, hit that subscribe button. You can unsubscribe at any time. There's no credit card required. We will not sell your information to any third parties. So I think it's a great deal, and it's just one way that we give back to our community. So make sure you go over to earningsbeats.com and sign up to get that free newsletter. One other announcement I want to make for our Earnings Beats members, paid members. We always have our Max Pain webinar the Tuesday before the 3rd Friday. Of course, the 3rd Friday of every month, that's when options expire. And so we always have the Tuesday before the 3rd Friday. May not be the 3rd Tuesday, right? I mean, if we have a, if the month opens on a Friday, the 1st would be a Friday, 3rd Friday would be the 15th. The Tuesday before that would be the 12th. That would be the 2nd Tuesday. So it's not always the 3rd Tuesday. Folks get that mixed up every once in a while. Always the Tuesday before the 3rd Friday. All right. Anyway, the webinar that we're having on Tuesday evening, instead of 4:30 in the afternoon, we are making a last-minute switch. We're going to move that to 7:30. If you can't make it, don't worry about it. We will have it recorded as always. You can always check out that recording later. But I just want to let our members know that Tuesday, March 15th, our Max Pain webinar will be at 7:30, not 4:30. I'm not going to be available at 4:30, so we had to push it back. All right, let's take a look at the daily market recap. Let's get this thing going. So on Monday, it was another not so great day. Looking at the Dow, you wouldn't know it. We're up 1 point. Yay, 1 point, 32,945. Anyway, S&P 500 down 31, so down about 0.75%. The NASDAQ down over 2%, down 262 points, down to the 12,581 level. Remember, we started the year, we were up near 16,000. We're now 12,581. Pretty significant drop. And for those of you saying, hey, we're not in a bear market, well, I think you need to do the calculation on the NASDAQ, because 20% of 16,000 will be 3,200. 3,200 off of 16,000 takes you down to 12,800. So we are down more than 20% on the NASDAQ, and we closed there. So we are in a bear market. Call it what you want. The S&P 500, okay, it's not down 20%. If you want to split hairs, go ahead and do that. Mid caps down, small caps down, growth stocks down, technologies down more than 20%, discretionaries down more than 20%, communication services down more than 20%. So if you want to hang your hat and say, well, the S&P is not down 20% yet, feel free. I think the S&P is going to be down 20% before this is all said and done. But if you want to wait, first of all, I wouldn't wait to start selling when you're down 20%. History tells us, if anything, when you go down 20%, you should be buying, not selling. So I think we go down a little bit more than that, but I have no problem with anyone from a longer term perspective using this weakness to build positions. That makes a lot of sense to me. The individual sectors, financials, up on Monday, up 1.26%. It went up as the yield rose. I actually posted in our Earnings Beats Digest newsletter on Monday, and I wrote about it over the weekend, that I think the financials and the banks in particular, normally with interest rates on the rise, we would expect financials and banks to do really well. I think that's not going to be the case this week, though. So as we look at the sectors here, you can see financials did really well. Financials actually gained 1.26%. That should be expected. We had the 10-year Treasury yield rising quite a bit on Monday, and normally financials and banks do really well. I do think, however, that banks could have a problem come Wednesday. That's when we get the Fed announcement, and I think right now it's going up. The financials going up with interest rates going up, but you've got to pay attention to why interest rates are going up. If it's because the economy is strengthening, I think that's a great sign for financials. If it's because of a potential inflationary deal, and especially during a period when the market could be in recessionary mode, I don't think that's a great environment for banks and financials. So yeah, we're getting a little bit of a bounce, or we got a little bit of a bounce on Monday, but I'd be really careful with that. And once the Fed announces on Wednesday that they're raising rates, I would not be surprised to see financials get hit hard. Just, my educated guess. We'll see what happens. Energy, you can see, had a very rough day on Monday, down about 3%. Crude oil price has been coming down, so energy, after the huge run it had, certainly deserving a little bit of a pullback and getting it down 3%, like I said, on Monday. Technology also weak, down 1.85%. Discretionary 1.67%, and communication services down 1.17%. These were the 5 groups that either went up or down by 1 or more percent on Monday. Financials the only one going up. Energy, technology, discretionary, and communication services all going down. And those last 3 right there, those are our 3 really aggressive sectors. It's never a good sign, in my opinion, to see these groups getting hit hard the way they were on Monday. So I don't think this downside's over. Could we, be bottoming maybe for a quick little bounce? I'm going to talk about that in just a minute. Before we get to that, though, let's take a look at the 10-year Treasury yield. 10-year Treasury yield, there's your breakout, 2.14%. And I think after hours last time I looked, it was up to 2.16%. So definitely making a big breakout. A lot of folks getting out of bonds right before the Fed meeting. Makes sense to me. I don't know why you would want to be holding bonds going into this Fed meeting. They're going to talk about inflation. They're going to talk about raising the Fed funds rate. Going to be a lot of reasons not to be in the bonds. But anyhow, probably we'll get a sell-off, or excuse me, not a sell-off of bonds, but I think you'll probably see some folks jumping back into bonds, bringing the yield back down, probably after the meeting. So it's kind of a, the buy on rumor, sell on news, or the sell on rumor, buy on news. I think that'll be part of what goes on here. So I think you're seeing the yield rise ahead of the meeting. I think you could see the yield pull back after the meeting temporarily. I don't know. Short term, I think we go a little bit higher on the 10-year Treasury yield. Longer term, I think we're going to go into a recession. I think the Fed will stop. I think they'll put the brakes on the rate hikes earlier than most people think. And I believe that we're going to potentially see rate cuts before the end of the year. So I think the 10-year Treasury yield, even though it might go up in the short term, I think ends up coming back down. And that will help to spur a lot of buying of growth stocks. But we'll just keep watching for now. I think you have to have patience. I don't think we're quite there yet. All right, let's talk a little bit about the, what happened on Monday. So this is talking technically. S&P 500. First of all, we're in a downtrend. If you didn't realize it over the last 2 or 3 months, you should be realizing it now. We continue to put in lower lows. Today's close, 41.73 on the S&P 500. If we take a look back, the last low a week ago, 41.70. So we were right there at that prior low. Of course, the other candle body that was lower was back on February 24th when we had an open of 41.55. So we do still have a little bit of downside support there on the S&P 500. Of course, on an intraday basis, we got down much lower than that 41.55. Here's the NASDAQ 100, also in a downtrend. But notice here, we've actually closed below that low from a week ago. And we also closed below the open that we saw back on February 24th. So the NASDAQ is in another breakdown. And this is not good. First of all, I think we're going lower, and it's never a good sign to see the NASDAQ going down faster than the S&P 500. It's telling us Wall Street is not yet moving into these more, these riskier investments. We continue to be in a risk-off mode, and that is generally the environment that sends prices lower. So NASDAQ 100 right now, could we bounce? Sure. I mean, we've been down. We've had, I don't know, 7 of the last 8 days have been down. 1, 2, 3, 4 out of 5. Yeah, 7 of the last 8 days have been down on the NASDAQ. So yeah, we could have a bounce anytime. We also could have an impulsive sell-off. I mean, we could see a really big down day with the VIX up into the 30s and just now starting to break down. Yeah, I think we got some issues that we're going to have to deal with. And, short term, yeah, we could bounce, but I still think the move, this downtrend that we're in is not over. And I think that takes us lower, and it may take us significantly lower, and it may take us significantly lower very quickly. So just have your guard up, be ready. This is the downtrend channel though, and I can show that on an hourly chart a little bit better. So here are your highs coming across here. You can see one high beginning of the year, one high mid-February, one high early March. Those three, if you connect them, there is your upper channel resistance line. Now, if you copy that and just drag that line over and connect this low in December, notice it actually comes down and connects the low on January 25th or 24th, I guess it was. So January 24th, when it came down here, we connected that, and we have remained in this channel now for over 2 months, 2.5 months, going on 3 months. Now, the black arrows you see, once we bottomed here in December and then put in that final high on the NASDAQ 100, which was at the end of December, this is the low. We had basically an equal low here. And so the resulting high after these lows is right here. So when you start looking at a downtrend, I look at the lower lows and lower highs. That's what defines a downtrend. So here's a low, here's the high. Here's a lower low. There's your bounce. That's your lower high. Here is your lower low. There's your ultimate bounce. There's your lower high. And then I didn't mark these because we haven't taken out these prior lows. It's not until we get all the way down here that puts in another lower low. Well, on the rebound, here's your double top, and there is your lower high. And now we've gone down and we're just putting in a new low on the NASDAQ 100. So right now it's marked, but we could still be going down. I mean, this may just go down with price action as we go here over the next couple of days, couple of weeks, whatever. So, looking at the market, we're downtrending. And you can say that we've gone down too much. You can say that we're going to bounce, but we don't have any confirmation of that at this point. And like I said, every time we go down, look down here. Here's the NASDAQ 100 versus the S&P 500. This is the ratio. We're setting new highs. So the NASDAQ is threatening this support area. We closed a little bit below it, but look at the relative ratio, NASDAQ versus the S&P. It's clearly breaking down. Not a good look. Now the XLY, XLP, you could say, well, we're not breaking down here. Well, that's good, except look at the recent lows. You see these lows coming across here? The NASDAQ pretty much has been holding this support area. Look at what the XLY, XLP did, just went to another new low. So I don't think there's anything really that's looking particularly bullish right now. I mean, if you want to look and just say that we didn't go down as much, on Monday on this, as maybe we could have, okay, but still the overall downtrend is in play. So I think you got to be real careful. I think the market remains, subject to potentially a big move to the downside. We've gone down the S&P 500 a little over 600 points since the beginning of the year. I think we could go down another 600. I think it's possible that we could go down to 3,500. If we do, I don't think it's going to be 2.5 months getting there. I think if we go down 600 points, you could see it in the next 2 to 4 weeks. I'm just saying that the conditions are ripe. I'm not saying we're going to do it, but I certainly wouldn't be surprised if we did. All right, let's move on to sentiment. And I thought what we would do here first, I wrote an article on Sunday in my Trading Places blog. And for those of you who haven't read or don't read my articles, I would highly recommend. I try to make them very educational. I try to give you a lot of things to think about. I'm not going to be right all the time. I realize that. Hopefully you realize that. You probably know that. Nobody's going to be right all the time. But I do try to give you my arguments, and then you can kind of evaluate whether you believe me, whether you don't believe me, you disagree, feel free. This is a difficult market environment anyway. It's always tough to figure out where the market's going. But I do think you get a lot of clues, and I try to point out the clues. Anyway, in this particular article on Sunday, I listed the last 10 recessions right here. And actually, when I went back and looked, I think there were 11. So it should have been 11 recessions. But anyway, these were the recessions that we've had over the past 70 years, since 1950. So 7 decades. And so it doesn't happen very often when we get a recession. I think we're on the verge of getting another recession. I think this is going to result in a recession. I think if we're not already heading there, the Fed is pretty much going to start putting nails in the recessionary coffin when they start raising rates. Because I don't think the market or the economy right now, given what's going on over in Russia and Ukraine, that conflict, the inflationary surge that we've got going on, sentiment numbers have been coming down, consumer sentiment, all of these things to me, the rising crude oil, crude oil surging up to $130 a barrel. All of these things are taking a toll. And I don't think the economy comes out of this unscathed. I think we're going to have a recession. But anyway, I pointed out all of these different drops. And before I show you why, I just want to make sure everyone is aware that if you do read my articles, or anyone over at StockCharts, any authors, if you go down below our article, there will be an area where you can subscribe to our blogs. There's no credit card, there's no fee involved or anything. All you got to do is just type in your email address. The beauty of it is I never even know half the time when I'm going to be posting an article. But as soon as my article gets published, it'll be sent to your email if you're subscribed to the blog. Now, this is not the same as subscribing to Earnings Beats over here for our digest. This is a 3 times a week newsletter that we do from Earnings Beats, from our site. We send out a newsletter separate from StockCharts. But if you want to get into the articles that I write over at StockCharts and you want to be aware of when they come out, that's when you should scroll down and make sure you're signed up and you subscribe there. All right, so those are the recessions right there. And what I did is on this next chart is I just went back and put in the last several. Here was the 2020 recession. Here was the 2007 when it started, actually right about the beginning of 2008. And then 2001, the recession. Here's 1990. That was the Persian Gulf. Here's the 81 recession. Here was the 80. We had them back to back. The 81 lasted, I don't know, well over a year. The 81 was very short-lived. And there's the big one, 73. I would just point out 73 right here. That was the secular bear market recession. Same with 2001 and the same with 2007 through 2009. These three were all part of secular bear markets. All the others that you see on here are recessions that occurred during secular bull markets. So some people think recessions are horrible, but they're just, they're going to happen from time to time. Market gets ahead of itself. The Fed starts to get a little bit more hawkish. They raise rates. Then the economy comes back down to skids to a halt. And then they cut rates and then the economy picks back up. It's just part of investing. You have to be aware that recessions will happen. Now, when you look at the recessions, every one of these recessions resulted in the stock market dropping, every single one of them. And so if you can spot it early, you can get out and miss a lot of the damage. I mean, this year I was posting and I've been warning our members at Earnings Beats all year, since the beginning of the year, since the end of last year, that the risks were really high heading into 2022. You never know for sure that the market's going to go down. You can have all kinds of signals, and sometimes the market just climbs that wall of worry and just keeps going up. But we had enough warning signs to tell us to be careful. And as I always say, that's why I use technical analysis. I use it to manage risk. And so when these recessions hit, if you can spot it before the recession hits, then you can get out of the market, let the market fall, and hopefully get back in before the recession ends. And the reason you want to get back in before the recession ends is usually the market bottoms before the recession ends. So the market's always looking in advance. So it spots the reversal in the economy long before we actually see the news. So that you have to understand that about the market. But the point I wanted to make here on this chart is down here on the bottom, I have the consumer sentiment readings. And if you take a look at some of the big drops, here was one at the late 70s and the early 80s. Well, guess what? We had two recessions on the heels of that. How about the big drop here in 1990? We started early in the year dropping. And by the time the recession started, we were at about a 6 or 7 year low on consumer sentiment. It wasn't like you get the recession and then you get bad consumer sentiment. It's the other way around. Consumer sentiment starts dropping and it's a leading indicator of a recession. Here is 1990. And you can see it was right before. Look at 2000. Before the recession hit, 2001, consumer sentiment was down and it moved to about a 4-year low. How about 2007? Right here at the beginning of 2007, we topped and the consumer sentiment dropped all year long before the recession actually hit later in the year and heading into 2008. Here you can see consumer sentiment pretty much just hit with the pandemic. That was a one-off. That's a little different than all these others. I think the pandemic just kind of caught a lot of folks by surprise, and especially the significance of it. I mean, we've had the bird flu. We've had a lot of different things. So I think when you first started hearing about the pandemic, I don't think the market was really reacting that strongly to it until we started to see more and more data. And then, of course, sentiment just dropped right away. But look at what sentiment has been doing now for almost a year. Sentiment has dropped from 88 or 89 down below 60 in just under a year. That huge drop, to me, is a major warning of a recession coming. And I'm not making this up. I mean, look at these other big drops. They preceded recessions. When consumer sentiment's dropping, you're not going to, if consumers are not in a great mood, they're not going to spend. And guess what happens when spending goes down? Well, since consumer spending is 2/3 of our GDP, it stands to reason that the GDP is going to go negative. 2/4 of that equals a recession. So you got to pay attention to consumer sentiment. And that big drop tells me, and especially it's dropping and it's been dropping for a year and the Fed's going to raise rates. Probably, or they're going to tell us multiple times. I don't know if they're going to raise rates multiple times, but they're going to try to tell us that probably on Wednesday. We'll see. Anyhow, I can't see us avoiding a recession. And that's what's taking everything down in the market right now. The other sentiment that I'll mention here, here's the VIX. You can see the VIX rising, the equity only put call rising, and here's the S&P 500 on the bottom. What I wanted to point out is when you get both the 5-day moving average of the equity only put call ratio and the 5-day moving average of the VIX, when they peak, they normally peak at a significant market bottom. Here we go, both peak, there's your bottom. Right here, both peak. Here's pretty significant bottom. Right here, both peak. Pretty significant bottom. Here, they both peak. Pretty significant bottom. Now here, they're not necessarily peaking, especially on the equity only put call ratio. We need to see that go up a little bit more. That's why I'm a little nervous we're going to break down. We need to see folks turn more bearish in the options world. More and more puts need to be played before we can really put in a bottom. So we'll see, how this plays out. But I think we are probably in a little bit of difficulty. Now, I did say that we're going to reset the sentiment in 2022. And I want you to look at these readings now on the 5-day moving average of the equity only. See how these highs are now topping everything else? This movement to the downside is helping us reset the sentiment, but we need more of it. I would love to see this 5-day moving average move up to about 0.80. And we've not even gotten close to that. In order to do that, we're probably going to need a big sell-off. That's why I think we could see a massive 600 points on the S&P 500 in a fairly short period of time. I would not be surprised to see it over a course of a couple of weeks. Again, it doesn't necessarily have to happen. I'm just saying the conditions are there. So please be careful. Moving on to earnings spotlight, just very quickly, one company coming out after earnings or after the market closed today, and their earnings, believe it or not. So you can see Coupa Software down $9.50. So it closed at 89. After hours, it's 64. It's down another $25. Would you like to know what their earnings were? Well, their revenues came in at 193 million. They were expected 185 million. So a huge beat on revenues. Earnings, 19 cents versus 5 cents. Huge outperformance, or huge beat. Stock down $25. Why? They lowered guidance. Can't do that in this environment. If you're a growth stock and you got a recession pending, market's not going to like it. And that's the problem. And we're seeing it across the board. Here's your 3 you must see. Apple broke to a new closing low. I've been writing about this. I wrote about it a couple months ago, made some bold predictions about Apple going to 140 back when it was trading at 180. Well, now we're at 150. We're not far away. These are two charts that continue to really bother me though. The first one is software breaking down to new closing low today. And then also semiconductors, same thing, breaking down to new lows. These are two groups that led us during the bull market, and they are leading us now in this cyclical bear market to the downside. We've got to see these two groups bottom and start to show some signs of strength, relative strength, and absolute strength, but especially relative strength. Until that happens, I think we've got issues. Anyhow, that's all I've got for today. I appreciate you tuning in. Thanks so much. I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live. Have a great day, everybody. Be careful out there. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.